What's up, finance enthusiasts? Welcome to another video by Accountify, where we demystify accounting technicalities and finance mysteries. Today's video is going to be an exclusive on an illustration for sensitivity analysis, as promised in the risk and uncertainty video. If you guys have not given a watch, go give a watch on that video. Apart from that, let's get right into the content, starting off with a quick revision for sensitivity analysis. Sensitivity analysis calculates the maximum change in a variable that would bring the net present value to zero. The variables here would be, for an example, revenue, cost of capital, variable costs, incremental fixed costs, etc. The formula here would be net present value over present value of cash flows under consideration multiplied by 100 to show it in a percentage. This would be the formula for sensitivity margin. So let's delve right into the illustration now. As you can see, this is the illustration we will be looking today. Batcher Company is considering investing $500,000 in equipment to produce a new type of ball. Sales of the product are expected to continue for 3 years, at the end of which the equipment will have a scrap value of $80,000. Sales revenue of $600,000 per year will be generated at a variable cost of $350,000. Annual fixed cost will increase by $40,000. What I can observe in the scenario is the sales revenue, variable cost, and annual fixed costs are constant. So we can make use of the annuity tables here if they require the NPV. So the requirement A reads, determine whether on the basis of the estimates given, the project should be undertaken, assuming that all cash flows occur at annual intervals and Batcher Company has a cost of capital of 15%. What they require in requirement A would be the NPV. So let's get right into it. To make it easier, I have already outlined the pro forma for the NPV calculation. So starting off with year 0, we would take the investment, which is the equipment. Equipment investment. The cash flow here would be a cash outflow of $500,000. So we have stated in negative terms. And then the next element we should take is sales revenue. This would be a positive figure as it is a cash inflow of $600,000. And then next, the variable cost. This would be a cash outflow since it is an expense. And then fixed cost, incremental fixed cost. This would be $40,000. And then last but not least, the scrap value. This would be $80,000. Now we have to take the discounting factors, which would be the annuity factors in this case. So let's refer to the 15% annuity table column. So this is the annuity table, 15%, period 3, 2.283 would be the annuity factor. So year 0, the annuity factor would be obviously 0, 2.283, what comes next? This would be repeated for both the variable cost and the incremental fixed cost, but not for the scrap value as it is a one-time limit. For that, we will be taking the present value table, the discounting factor for year 3. So solely 0.658. So we put 0.658 as it is yet again a one time. Now we can calculate the individual present values. 3 multiplied by 2.283, similarly 40,000 multiplied by 2.283, last but not least, scrap value multiplied by 0.658. As you can see, when we sum it, we would get 32,070 as our NPV. Now, having this, we can calculate the sensitivity of what comes next. So requirement B is next. Find the percentage changes, which is again sensitivity, required in the following estimates for the investment decision to change. Starting off with the first part, which is initial investment. Take the NPV first. NPV equals, let's lock this here so it would be easier for copying it. And then we can take the initial investment amount. Specifically here, notice we will not take the cash flows here, we will take it from the present value. So the initial investment, I know it is the same, but still we would be taking it from the present value column. Now we can calculate the sensitivity margin. This would be 32 not 70 over 500,000, giving us 6.41% as our sensitivity margin in PV over initial investment. We can do the same to the rest. So next up we have scrap value. Can copy this, change this part. So the scrap value taken here would be from the present value column, which is 52,640. Therefore, NPV divided by the scrap value would give you 60.92%. Similarly, we can do it to the next, which is selling price. Selling price, we have to take the sales revenue. Selling price. So the sales revenue from the present value column, which is 1.3 million. Therefore, we can find the sensitivity margin being 2.34%. Now, the fourth would be the unit variable cost. So we can make use of the variable cost here. Variable cost present value is 799,050. And we'll make the elements positive when doing the calculation, or you get a funny looking percentage. So the sensitivity margin here would be 4.01% NPV over variable cost. Lastly, we can take requirement. This would be the annual fixed cost. Fixed cost. This would be the present value of 91,320, which would give a sensitivity of 35.12%. Next up, we can calculate sales volume. So for the sales volume, instead of taking the sales volume, we would be taking the contribution here. Contribution in this case would be the present value of sales subtracted by the variable cost. If you notice in the cell, I put the positive figure because originally the cell is already in a negative. So we can calculate the contribution to be 570,750. The sensitivity margin would be 5.62%. And lastly, cost of capital. Now this is different. But before going to the cost of capital, I'll give a small interpretation on each of the calculations we have done here. Starting off with the initial investment requirement A. As you can see, if the initial investment increases by 3270, as it is a cost, the NPV would become 0. So that is what is calculated here, 6.41. So if it increases by 6.41%, which 6.41% of 500,000 is 32,070, by the way, you can check it. If it increases by 32,070, the NPV would become 0. And similarly, scrap value, since it is a cash inflow, if the scrap value reduces by 32,070, which is 60% of the scrap value here, by the way, 60% of the scrap value is the NPV of 3270. So 32,070, if the scrap value reduces by that amount, the NPV would become 0. And then similarly, the selling price, which is the sales revenue. So if the sales revenue drops by 2.3%, which is that again 2.3% of selling price would be 32,070, the NPV would become 0. Same can be applied to variable cost. If the variable cost increase, if it is a cash outflow, it should increase so that the NPV drops. And if it is a cash inflow, it should decrease so that the NPV drops. So the variable cost, if it increases by 32,070, which is 4.01% of variable cost, the NPV would become 0. Annual fixed cost, the same cash outflow. No? If the cash outflow increases, the NPV would become 0. Contribution, if the total contribution decreases by 5.62%, the NPV would become 0. So I hope you guys understood that. Now we can move on to cost of capital. So the cost of capital given in the question is 15%. Calculating this is a bit different because we will have to utilize another known method. So let's put on the cost of capital here, which is 15%. So how we are going to calculate the sensitivity of the cost of capital would be, we are going to utilize the IRR. Now you might be wondering, why are we going to take the IRR? The reason we're going to take the IRR is because IRR is when the NPV becomes 0, the internal rate of return when the NPV becomes 0. So using that, we can, after calculating the IRR, we can calculate the change in the IRR by comparing it with the original 15% cost of capital and figure out the sensitivity there. So starting off with the IRR calculation. Before that, a small revision on the IRR formula for you guys. So the IRR formula would be big rate minus the small rate over big NPV minus the small NPV, the whole figure multiplied by the big NPV, and after that we add the small rate to get the internal rate of return. So the IRR calculation. Starting off with the big rate. Since we have to make assumptions here, it can be subjective for each one of us. What I would recommend is take a 5% gap between the estimates you take. So since the cost of capital is 15%, the cost of capital should increase if the NPV should decrease. So what you should do here is you should increase the cost of capital. So you should increase it by 5%. So it should be 20%. So that's the assumption made here. But again, subjective, there is no specific method on how you should get it. And 15%. So the big rate would be 20%, 15%. Why did we take a higher rate? We took a higher rate because the more the cost of capital increases, the NPV decreases. There's an inverse relationship there. Now next we have to take the big NPV and the small NPV. So the big NPV would be the 32,070 here. Small NPV would be the one we have to calculate based on the 20% figure here. So to make our life easier, we can directly take the contribution. Since we're going to make use of the annuity tables, the contribution here would be 600,000 plus the negative variable cost. 600 minus 350,000 would give you 250,000 contribution.
One eternity later.
Now we can calculate the present value for each of these. 500,000 into 1, 50,000 into 2.106, 40,000 into 2.106. Same can be repeated here. Then the total NPV would be the sum total for this. This would be a negative value of 11,420. Now we can move on with the IRR calculation. So firstly, what we do is, you guys can use the formula tab here. We take the big rate, then deduct the small rate and divide it by the big NPV deducted by the small NPV. When you guys are doing this in paper and pen, what you guys can notice is negative times negative would be positive. So ensure the sign accuracy is there in your end, most importantly. And if you are doing it in Excel, ensure the brackets are applied properly. But there is an IRR formula which I will discuss on a separate video, by the way. So that would be multiplied by the total big NPV now. And finally, we can add the small rate of 15%. Now we get an IRR of approximately 8.69%. Now to calculate the change, which is the sensitivity margin, this time we will not apply the traditional formula. put a bit of a change in it. So the change would be the difference. We are going to take the IRR, the rate at which NPV is 0, which is the IRR, 18.69. Look closely at the formula tab. And then I would take the cost of capital, original one, 15%, deduct it, 18.69 minus 15, and then lastly divide it by 15%. This would give a percentage change of 24.58%. So this is the sensitivity of the cost of capital. I hope you guys understood that. So that's all for today's video. Thanks for watching. Be sure to catch up in the next. Signing off, Lukman Akram.